On today's show, whether you are happy in retirement depends on many things. We've put together a list of things that can help your retirement be a happy one on today's episode of Elevate Your Wealth.
And now, Elevate Your Wealth with Mark Stimson and Casey Elkins.
Welcome into Elevate Your Wealth. Your hosts, Mark Stimson and Casey Elkins. You can find them right here in Seattle. Elevated Financial Management, 42 years combined experience between these two, and it's always about retirement planning, helping their clients get ready for their retirement. They are certified financial fiduciaries. I'm Morgan Patrick, consumer advocate, and again, it is always retirement topics. And here's the cool thing about this show. We give you an opportunity to take action on your own behalf. That's right. We have 10 appointments for our radio listeners. We've carved them out, and they are for you, and they are complimentary. We'll tell you about it as we move through the program, but this is an opportunity, if you have not started planning, to get going on it. If you're in the middle of something, but you're frustrated, you're not being communicated with, it's an opportunity to get a second opinion. So stay tuned. We'll get to that here in just a little bit. So some retirees, they're happy, while others are just downright miserable. There's a full spectrum there. And according to financial planners, what separates the happy retirees from the unhappy ones, it basically comes down to a few things that's done right or wrong in pre-retirement planning. So here's what differentiates the happiest retirees, okay? So, Mark, let's just start with you. The freedom of being debt-free. If you're debt-free, that's a big help.
That is a ginormous help. And I think the listeners today are really going to like this show today. We're going to share with you some very easy things that you can keep on the lookout for and then put into practice, right? And some of these things are going to make a real difference in your retirement. The first one you just mentioned, Morgan, how nice would it be to be debt-free? We know that when retirees don't have any debt, they have more flexibility to spend money on what they want to do, really have some fun. It isn't just about paying your basic bills and that being it. That's not the type of retirement that we set up for our clients here at Elevate Your Wealth. So, when you really think about having less stress, how wonderful is that going to be? And one of the biggest ways to get into retirement and lessen your debt load is going to be to pay off your mortgage. That's going to be one of the things that's going to make the most difference. Now, this is where we won't spend a lot of time, but this is where a reverse mortgage could make a huge difference in your retirement plans if you truly understand how reverse mortgage works, especially if you have a balance left on your existing note. That's going to take us into the next thing that we want to talk about today is monitor your spending. You've got to be willing to do this. One of the things that we have our clients do when they first come in is we give them a expense sheet. We need to figure out what their cash flow is going to be. And I will tell you that when you go into retirement and you don't have that guaranteed paycheck every week or every 2 weeks, however it was that you got paid, you need to have a budget. You need to know what's going out. So please track your expenses. It's going to make a huge difference in your retirement spending, how and when you do that. In fact, we recommend that for the first couple of months that you retire, keep track of everything that you spend. Keep something on your person so that you can write down a Starbucks or a sandwich. You pay a bill, you buy groceries, whatever it is, we need to know exactly what you're spending each and every month so that we can develop a spending plan that's going to truly work. You don't have to be an accountant and spend hours on a computer each week unless you really want to. Many people just develop a very simple methodology to stay on top of what they're spending, which really boils down to a budget and knowing exactly what's coming in and what's going out. So those are going to be a couple of really important things. Freedom when you're debt-free and monitor your spending. That's going to take us now, Casey, to a couple things that you want to talk about. And one of them is clear communication with your better half.
Yeah, this is really important. Not only when it comes to finance, but just in general, right? Clear communication with your spouse. That's key. That's important to any relationship. To make sure that you're communicating properly, but especially when it comes to finances and you're moving into retirement, you both have to be paying attention to the household budget. It can't just be one person that bears that burden or is always kind of harassing the other one about what's being spent. You both need to be on the same page. And it really helps couples to be better prepared if the spouse who handles the finances, if something was to happen to that one, perhaps they're incapacitated or whatever the circumstance may be, the other spouse needs to be able to pick up the slack. And so it's normal for one spouse to handle the finances more than the other, but both need to be on the same pages. And it requires open lines of communication to do that. Not only is that helpful as you're going through retirement, but as well, whenever things change, the plan changes, or there's adjustments that need to be made, everybody needs to be on the same page as to how that's all going to work. And then it's not just about that communication. It also comes down to making sure that your income sources are set up properly too. So you want to be diverse in the income sources that you have. That's our next thought. The retirees who are most content have not only saved well, but they've saved in the right way. It's one thing to have the dollars. It's another thing to have them set up in a way that they're going to take care of you and make sure that that money is growing and yet also producing income for you too. So that means that you likely have multiple income sources in retirement. You probably don't want all your retirement income to come from a tax-deferred 401k plan or an IRA. We find that our happiest clients are those that have 2 or 3 or more income sources, guaranteed income sources that they're not going to be worried about as to what the market is going to do to them or if they're going to have the income that they need next month. And so that's a conversation that you've got to have and make sure that you're moving down the right path as far as your investments are concerned.
You know, going over just getting a few things right in pre-retirement planning so you are going to be happy as you move into retirement and through retirement. You're listening to Elevate Your Wealth, powered by Elevated Financial Management, and we talk the talk and we also walk the walk. We give you an opportunity to get on the counter with Mark and Casey at Elevated Financial Management. These appointments are no cost, no obligation, no pressure. If you've saved $250,000 or more towards your retirement, these strategies are going to work best for you. We have 10 appointments. They are now open. You can call at any time, 866-668-3625. That's 866-668-3625. Again, going over some pre-retirement planning that you can get done. You need to cover some of the bases, make sure you're debt-free as much as you can be, and then monitor that spending, have that budget. Clear communication with your spouse when you're headed into retirement, and be diverse with your income sources. Now, the next two, I'm glad we're starting with Mark on this one, because you need to have an active social life. Now, Mark is not retired yet, but I have a feeling he's on his way to being a pro pickleball player, a pro golfer, leading the conga line. I mean, these are all important things. You want to have that active social life, don't you, Mark?
That is exactly right. I am so glad we're talking about this right now, Morgan, because an active social life is critical to a happy retirement. You cannot not have it and think you're going to be successful. We can't overemphasize how important it is to talk about this subject, because so many in Wall Street, all they want to talk about is the money. We talk about so much more here at Elevated Financial Management, and one of them is, what are you going to do with your life? Are you going to remain active? Are you going to want to do things? I know you mentioned, Morgan, I love to play golf. I love to play pickleball. I love to travel. I love to ski. So
he loves the conga line.
I was going to say,
come on, man. Where's the conga line? Come on.
I know, exactly. So I want everybody listening, that's what a true retirement plan is going to help you figure out. What are you going to do with your life? Where are you going to live? How active do you want to be? And hopefully your health is going to allow you to be very, very active. And so you don't have to always be the belle of the ball like they want to make it sound like I am, but it is important to stay involved. Couples need to feel that they have a sense of purpose. That's really, really important. And what if maybe you might want to work just a little bit, maybe one day a week or half a day a week? What about volunteering? There's a lot of ways to stay active socially, because when you pull that switch, so many people don't realize that the bulk of their socialization came from their job, from their workmates, those that they spend 8-10 hours with. And when that goes away, it creates a void that's got to be filled. So you want to get a life that you're doing things. It's going to help you reinforce the fact that you matter as a person and you have value. And so I can't recommend enough how important that really is.
So moving to this last one, Casey, just having that overall lifestyle plan. I mean, we end up talking about numbers so much, but you really need to think about lifestyle.
You do. You have to. I mean, it's so important. As to Mark's point, having an active social life. But what is that lifestyle going to look like? The numbers are one thing, and they're very important. You can't have a successful retirement without the savings. But ultimately, at the end of the day, they are there to support your lifestyle. And very few people, very few planners talk about a lifestyle plan. And so the big question is what do you want to do in retirement? And for those listening at home, for our first 10 callers, that's one of the very first things that Mark and I are going to ask you when you come in and sit down with us. We're going to ask you what you want to do in retirement, how you want to spend your time. And so with that, you're going to get a written financial plan put together by our team of certified financial planners. We will walk you through step by step what that plan looks like. We'll make suggestions on how to make improvements from where you currently are. We'll talk about taxes, how we can lower the taxes, how we can increase your income sources, and make sure that you're going to have the retirement lifestyle and the retirement that you've been dreaming of all along.
Here's the phone number to call to grab one of those appointments, 866-668-3625. That's 866-668-3625. If you've saved $250,000 or more towards your retirement, these strategies are going to work best for you. Call right now. These are complimentary appointments, 866-668-3625. One more time, 866-668-3625. When we return, the new year brings new provisions that will change retirement laws as we currently know them. Increasing the RMD to age 73 is just the start. We'll be right back with all the details right here on Elevate Your Wealth. Welcome back into Elevate Your Wealth, powered by Elevated Financial Management. You can find them right here in Seattle. Mark Stimson, Casey Elkins, your host. Again, 42 years combined experience between these two. They are fiduciaries, and it's always about retirement planning. And we get it. You could be very, very busy out and about doing lots of different things, and you can't listen to the entire show. You can always go to a great resource website. Check it out, efmnw.com. All letters, efmnw.com. Again, TV show links are there for you. You can see the fellas. You can also catch most of our radio programs in podcast form right there at efmnw.com. So check it out. I'm Morgan Patrick, consumer advocate. The Secure Act guys and Secure Act 2.0 bringing a lot of changes to the laws surrounding retirement. And the biggest change so far is raising the age of the RMD, the required minimum distribution, from 72 to 73. And of course, man, I can't believe we're saying it, 2024. It's just the beginning, though. So we want to kind of dig in and see what else is new. Mark, we're going to start with you. Inflation adjustments for IRA catch-up contributions.
Yeah, this is one of the nice new changes that is affecting all of us in a very positive way. So let's talk about, remember, in 2023, you could contribute $6,500 into your IRA account, and you could do another $1,000 as a catch-up provision if you were 50 or older. Well, for 2024, it's gone up another $500. So instead of $6,500, you're going to be able to contribute $7,000. Okay, and it's going to then, they're indexing for inflation moving forward, and that's all part of Secure 2.0. So, it enables the IRS to adjust the limit over time. And they're doing us a nice thing. The government doesn't always do this, but in this case, they're responding to the increases in costs of living. They've gone through the roof, as we all know. We could go on and on about inflation right now, but it's bad. Now, the annual increase on the increase for if you're over 50, the catch-up provision has really been stalled at 1,000 for a while now. So hopefully in the very, very near future, that's going to change as well. But that takes us to a subject that we all need to think about, and that would be Roth 401ks. And there's been a nice new change when it comes to RMDs for 401ks.
Yeah, this is really good. Under the Secure Act 2.0, Roth 401k plans will be included in the list of exempt account types starting in 2024. So what that means is that up until 2024, even your Roth 401k, even though that money was post-tax, meaning you had already paid tax on it, you're not going to pay tax on it again, the required minimum distribution did apply to those dollars, which seems unfair, illogical, whatever term you want to throw at it. It didn't really seem to make much sense that you have this account that you're not going to pay taxes on, but they're going to force you to take money out of it when the reasoning behind RMD is specific to taxes. So it really didn't make much sense. And so that's being done away with. Your contributions to your Roth accounts are post-tax, and so those account holders have already paid income taxes on the contributions, and they'll be able to withdraw that money tax-free in the future. And beyond 2024, we won't have to deal with RMDs for those particular accounts. So that's a good thing. It's giving you more flexibility. It's allowing those funds to grow longer in retirement, and making sure that you're getting as much tax benefit from it as you can, given the fact that you can wait longer to take that money out, assuming that taxes go up over time, which I think we talk about a lot, and I think we're all on the same page that they will continue to go up. That brings us to that next point, Mark. So inflation adjustments for qualified charitable distributions.
Yeah, in fact, this is something that we're working on. We have a client right now that's actually using the short term is QCDs, so qualified charitable distributions and deductions are something we want to understand a little bit. Now, it was capped this past year at $100,000. These, when you have and are using a QCD, they contribute to the required minimum distributions, which is nice. So if you gave away, let's say $50,000 to a charity that you love and you want to get that deduction, that's also going to help you with that $50,000 RMD, or go towards any RMD that you might be stuck with, is what we like to say in this business. Now, since RMDs are typically taxable income, making a charitable donation from a portion of your RMD is going to help you reduce your overall tax liability. So thanks to, Secure 2.0 Act, the $100,000 limit on QCDs is going to undergo inflation indexing starting this coming year in January. So instead of $100,000 being the max, they're giving us an increase of $5,000. So this adjustment's going to raise the level that you could actually give to the charity of your choice up to $105,000 next year, which is going to reduce that taxable income for you. And that's going to reduce, of course, your RMDs. So with that being said, it's a great planning tool that can help reduce taxes as long as you're willing to give up control of those funds. Some people are willing to do that, others aren't. So that's why your situation is very unique to you and no one else.
Tell you, it's so very, very important to be ready for all the changes that are coming. Make sure you have a plan that's taking all of this into account. And again, Secure Act and Secure Act 2.0 are bringing these changes to the laws, and you need to be aware of them. The biggest change, obviously, we talked about RMD distributions from 72 to 73, but the fellows have already talked about inflation adjustments. Again, no more RMDs for Roth 401ks, and inflation adjustments for qualified charitable distributions, all very, very important. If you are sitting there going, wow, I had no idea, and you're scratching your head a little bit, it's okay. We open up appointments with Elevated Financial Management, and it's an opportunity for you to kind of kick the tires, get to know the fellas. And if you have not started planning, man, get going on it. Or if you need that second opinion. And again, the 10 appointments are available. If you've saved $250,000 or more towards your retirement, these strategies are going to work best for you. The number to call to grab one right now, get ahead of it, right? 866-668-3625. That's 866-668-3625. All right, so back to some of the changes. Let's go to this one, Casey. Matching retirement contributions for student loan payments.
This is really cool, actually. This is something, Mark and I were just talking about this on the break. This is something very, very exciting, something that most folks are probably unfamiliar with and haven't seen before. And so what it is employers can opt to match their workers' student loan payments with contributions to the workers' retirement accounts. So again, starting in 2024. So what that means is, we'll just give you a scenario. If you make a $500 payment towards your student loan, your employer could make a $500 contribution to your 401k.
Yeah, very cool.
It's very, very cool. Something that I hope employers take advantage of, and I hope that they use that to attract talent in their industry and encourage people to come in with degrees and things of that nature. I think that's very important, but it is a very interesting tool and something that really could be a big benefit to those that still have the student loans. In addition to that, when we think about education costs, the other idea that we'll bring out here is that rollovers from 529 plans to Roth IRA. So this isn't something that was available previously. So with the Secure Act 2.0, it allows for a limited amount of tax-free or penalty-free rollovers from a 529 college savings plan into a Roth IRA. So there are some limitations, which means that those rollovers are limited to a total of $35,000 over the course of a 529 account beneficiary's lifetime, and they're restricted to 529 accounts that have been open for more than 15 years. But why this is so important is because sometimes not all the dollars inside of a 529 plan get used for college. And so now that money, instead of being a problem, can be rolled over into a Roth account and just become an investment for that individual for the next however many years of their life. And so this is really giving more flexibility and allowing people more control over their funds, which Mark and I will hear us talk about control a lot. That is very, very important as you're moving towards retirement, maintaining control and having a plan.
I mean, so important. Again, the plan part of it, making sure you're aware of all the different changes. We're just going over a few of the Secure Act and Secure Act 2.0 changes that are coming with the new year. So, Mark, we've got the 10 appointments available at your office. They are no cost, no obligation, no pressure. Walk us through what's going to happen at these appointments.
Yeah, so if you've been listening today, please pick up the phone and give us a call. Again, maybe you work at Boeing, or you've been at Warehouse or any of the wonderful companies in the Pacific Northwest. Give us a call, because what we want to do, like Casey just mentioned, this thing about employers matching loan payments, how cool is that? So many individuals don't know the different tax strategies that are going to be available to you if you talk with someone that might know a little bit about taxes, and we're pretty good with taxes in our office. So if you want help, we're going to put together a plan from our team of certified financial planners. Pick up the phone. Leave your checkbook at home, though, because you are not going to have to bring that in for this initial appointment. We're going to look at your situation. We're going to see where your income is coming from. We're going to really look hard at taxes. We believe that gets missed. It doesn't want to be talked about by your big box stores. So please pick up the phone. Let's have just a conversation about your specific situation, and let us make a true difference in your retirement goals and dreams.
10 complimentary appointments. They're open right now. If you've saved $250,000 or more towards your retirement, these strategies are going to work best for you. The number to call to secure your spot is 866-668-3625. That's 866-668-3625. This is an opportunity for you to get started with your planning, or if you're in the middle of something, you've got questions, you're not being communicated with, you're a little frustrated, it's time for that second opinion. Call the number 866-668-3625. When we return, annuities can be a valuable tool in your retirement arsenal if, and I say if, you choose wisely and use them the right way. We'll talk about it when we come back. Elevate Your Wealth, hosted by Mark Stimson and Casey Elkins. You can find him right here in the Seattle market. Elevated Financial Management, the power behind this program. Mark and Casey have 42 years combined experience in the retirement planning business. They are fiduciaries. I'm Morgan Patrick, consumer advocate. We go back and forth on so many different retirement topics. We're here to help you. If you have any questions about your own situation, maybe you haven't started planning or you're in the middle of something you desperately need a second opinion, I've got great news for you. On this program, we open up 10 appointments for the upcoming week or when it fits your schedule, right? And these are complimentary appointments. If you've saved $250,000 or more towards your retirement, now these strategies are going to work best for you, but you can grab an appointment at any time now that they are open while they last. 866-668-3625. That's 866-668-3625. All right, so you bring up annuities and you're often going to get an earful. Some of it's pro, a lot of it's con. Bottom line is annuities used correctly, used in the right way, can complement your retirement portfolio. Now, there are a lot of moving parts and the details can be, they can be confusing. So we wanted to kind of take a look at some things you need to know about annuities. And first and foremost, work with professionals that do this on a daily basis, can take a look at your portfolio, see if there's a good fit, okay? Mark, we start with you. One thing you need to know about annuities, you can't just go, I've signed up, but I don't like it. You can't just back out.
Yeah, that's something that you just can't do. And so I want to start by saying annuities, you're right, they do. They get a bad rap a lot of the time, but I'll tell you, it's because people do not understand them, and they also are not considering the source of that bad information. We will tell you here, I truly believe if a true fiduciary doesn't use annuities, then he's not a true fiduciary. So annuities do some things that no other retirement vehicle can do, and one of them is protect your money with a 100% principal guarantee, and then if you need to, turn on an income stream that you cannot outlive, including your spouse. And what I'd like to add to that is if you've got a Social Security check and you don't like annuities, well, then you need to give up your Social Security check. We laugh about this all the time because Social Security is an annuity. Every pension plan, if you're fortunate enough in the United States to have a pension, which we love, I wish I would have a pension, it's an annuity. So anybody that wants to talk about how bad annuities are and guaranteed income is, they're missing the boat. And they need to be used in the right way. But you can't just back out, like we mentioned. So in exchange for income guarantees that can be given for life, you're going to have to agree to a certain surrender period, which usually most will be anywhere between 5 and 10 years, depending on the contract and what you are wanting that annuity to do. One of the first things Casey and I do is we determine upfront what we want that money to do. We're not going to sell a product. We're not going to sell an annuity or life insurance policy unless it's needed. And so you have to determine what do you want that money to do. So if you have a surrender charge period and you take out more than maybe the free 10% out, you're going to have to pay back some of the interest just like you would if you cashed in a CD early. It's no different than that. And if you break that agreement and you cash it all out early, you're going to have to pay a fee. The earlier you cash it out, the more the fee is going to be. But we don't have that happen because the annuity, that when we have to use them, is helping with a very specific problem that can't be handled any other way. So you have to understand annuities and work with somebody that can help you with all of the complexities that we're talking about, because they are complex. There's going to be interest rates, withdrawal rates, cap rates, spread rates. Do you understand these things? I know that I've been doing annuity business for some of my clients for over 40 years now, and they can be complex. But you have to, if you understand them, they work really, really well in very specific situations. You're going to have a guaranteed withdrawal amount. If we've set up an income annuity, you're going to get that for life, and so is your spouse. If she's taken a joint payment off of that. You know, there are cap rates that we have to deal with that can limit your upside potential. But some of the cap rates right now are excellent when it comes to the S&P 500. We're seeing cap rates now over 10. So these contracts have changed. Please, if you're confused about annuities, don't just think that they're a bad investment, because they're not. If they're used in the right way, they are an asset class that can be a tremendous value to your account. One of the things you got to be aware of, though, Case, is bonuses. How does that work?
Yeah, with an annuity, sometimes when you purchase one, an insurance company will want to give you a bonus as a way to incentivize you to use their particular annuity, right? And we see that a lot. But the reality is this: insurance companies aren't in the business of losing money. So we want to make sure that we understand what that bonus is, what the benefit is, and make sure that it doesn't just make it appealing. To make sure that we want to make sure that that actually is the right investment. We don't want to go after it just for that bonus. So if they're offering a bonus, there is likely some way that they're offsetting that, because again, they're a for-profit company. And the reality is this: we want them to be successful. We want them to make money. Absolutely. Because that allows them to continue to do what they do, which is something that nobody else does, right? The market does not offer 100% principal protection. The market does not offer lifetime income streams that you can't outlive. So we want those companies to be profitable. And yet at the same time, we also want to make sure that we're being taken care of too. So it's important to have that balance when we think about it. Now, before I move to the next point, I just want to kind of touch back on what you were talking about, Mark, and annuities and sometimes how they get a bad rap. And, we understand that. But the reality is this: people are afraid of what they don't understand. Yeah, right? That's the key. Yep. And so many people don't understand annuities. But the reality is this: so many people don't understand the market either. Yeah. And yet, for some reason, the market doesn't seem to be as scary as annuities are. And so, as Mark mentioned, be careful where you get the information. Talk with somebody who can help you understand and help you understand why it may make sense in your circumstance. The reality is this: it may not make sense in your circumstance, right? Mark and I are not sitting here saying you need an annuity. That's not what this is about. But the truth is that there's some clients that an annuity is the greatest, most perfect fit for. And there's some clients that it absolutely does not fit for. And most clients fall somewhere in the middle. So just have the conversation, be willing to talk about it, keep an open mind, and figure out what it can do for you. Because that's really the key, right? It's just a tool. And given the right circumstance used in the right way, if it's the right tool, it can work really well for you.
I mean, the goal is to get to retirement, enjoy retirement, and work with professionals that can advise you on how you're going to get there the best way. And it might include having an annuity as part of your portfolio, but it takes a conversation. And as you have already pointed out, fellas, it can be complicated, but if you're educated on it, it might be a good fit for you. But you need to ask questions. You need to get those answers. You need to work with a fiduciary and see if it is a good fit. Now, speaking of that, we have 10 appointments available with Elevated Financial Management. They're the power behind this program. Again, your hosts, Mark Stimson and Casey Elkins, you can find them there every single day of the week, and they are working hard for people's retirement and getting plans together. So these appointments, we have 10 of them. They are complimentary. All you have to do is call this number, 866-668-3625. If you've saved $250,000 or more towards your retirement, these strategies are going to work best for you, but you can ask questions about maybe an annuity is a good fit for your portfolio if you'd like to add it. But again, you can ask the question. Call the number, 866-668-3625. All right, so let's get to the bottom line here. And Mark, will end this with you on this portion of the program. But when it comes to annuities, yes, ask a lot of questions, but know how the person selling you the annuity is licensed, but also how that person gets paid.
Yeah, that's really, really important that we understand that, because, that's one of the first things people worry about. Okay, a person that sells annuities is just worried about a commission. That couldn't be farther from the truth. A commission is going to be paid, but it's nice that it comes out of the carrier's money, not out of your money. In fact, to be very frank and upfront, we actually make more money with money that's in the market, because the fee that gets charged there never ends, where it does with an annuity contract. So be careful of where you get the negative noise about, if he sells you annuity, he's just looking for a payday. That couldn't be farther from the truth. So, but you need to have somebody that's licensed. They need, A true fiduciary is really going to look out for your best interest, whether you're using an annuity, you're using the market, life insurance, it just doesn't matter. You've got to be putting the client's interest first, so that and when you do that, the conflicts of interest are going to be reduced or go away for forever pretty much. But there's one thing that we didn't talk about this last section, and when you're moving money, you need to do this the right way. And Casey, why is that so critical?
Well, the reality is this: if you already have an annuity and you're moving it to a new annuity, let's say you're replacing an older annuity, there's a couple of things that should happen. It should go directly from the annuity that you have into the new annuity. You would not want to cash out the old annuity, take those funds, and then move it into the new annuity. That's kind of a side step that you wouldn't want to do. It should go from the institution that it's currently at to the new institution. And this is important because it triggers an audit for your protection. So the point here is this: if you already have an annuity and you're going to move it to somewhere else, to a new annuity, that triggers a third-party audit that's going to require the new insurance company to review that information and make sure that that is in your best interest and that that is an appropriate move for you, to make sure that it's not just being moved for the sake of being moved, right? We want to make sure that it's being moved to truly benefit you as the client, and that's really the key, to make sure that you do it the right way and that you're working with somebody who's a fiduciary who has your best interests at heart.
I mean, a nice safeguard. And again, folks, ask questions, work with a fiduciary, and possibly an annuity might be that fit, again, for your portfolio. All right, guys, we've got 10 appointments. Let's open them up right now. And again, these are complimentary.
So for those listening at home, if you got $250,000 or more saved for retirement, pick up the phone, give us a call. What we're going to do is we're going to sit down, we'll have a conversation with you, and ultimately what that's going to net out to you is a written financial plan put together by our team of certified financial planners. So we'll have a one-on-one conversation. We'll take the time to get to know you, to get to know what your goals are in retirement, to analyze your finances, your current investments, and start to determine if there's a way to improve that, to make sure that you're on the right path for retirement success, and ultimately figure out ways to lessen taxes, lessen volatility in the market, and increase the income that you're going to have in retirement. So don't hesitate. Pick up the phone. Give us a call now.
10 appointments. Again, no cost, no obligation. There is no pressure. If you've saved $250,000 or more towards your retirement, these strategies are going to work best for you. The number to call is 866-668-3625. That's 866-668-3625. Call now. They will not last long. Coming up on Elevate Your Wealth, we'll get into some retirement scenarios. We'll see what Casey and Mark come up with. Elevate Your Wealth. Your hosts are Mark Stimson and Casey Elkins. You can find them right here in Seattle at Elevated Financial Management. Check them out online. Great resource website, EFMNW.com. All letters, EFMNW.com. Again, TV show links are there for you. Radio show and podcast form links are there for you so you can watch and listen. But great information on retirement planning. And between Mark and Casey, 42 years combined experience in the planning business. It's always about retirement. They are certified financial fiduciaries. I'm Morgan Patrick, kind of a co-host, but I am the consumer advocate. We go back and forth on these topics. And again, it's about helping you with your retirement planning. If you have not started, listen up. We've got appointments available for our radio and podcast listeners, and they are complimentary. If you are in the middle of something and you feel like, you know what, I need somebody to take a look at what's going on because I'm just a little bit confused, I'm a little bit frustrated, it is A-OK to grab a second opinion with one of these appointments. The number to call is 866-668-3625. You can get that process started, 866-668-3625. These are complimentary appointments. All right, scenarios, guys. First one up, Casey, to you. We have multiple financial advisors wanting to help us manage our money. Most of the firms have an invest, diversify, and hold strategy. The most recent firm that wants to manage our cash sounds like they're a little different in that they are more proactive in looking ahead and positioning assets for long term. With all of these firms, How can we decide which one is best for us?
That really is a tough question, right? You've got everybody kind of trying to get your business, I guess we could say, and ultimately you want to make that right decision. And so there's a number of things to consider. I'll say this: I think one of the most important things when it comes down to it, as far as picking which firm you're going to work with, which advisor you're going to work with, is comfortability, right? You get a feel for people when you talk to them. You get a feel for them when you hear them speak with others. You get a feel for them when they explain things to you or when they're talking with you about different financial concepts. And ultimately, that relationship is so important. It's like a marriage. I mean, when Mark and I sit down and we talk about the clients that we've got, it really is a long-lasting relationship, and it's one where you've got to be comfortable with the person on the other side of the table. So I'll say that's one of the first things to consider. Who do you feel comfortable with? Who do you have that initial gut reaction that this person feels right to me? In addition to that, are they fiduciaries? So you've mentioned different firms and the different ways that they invest, but are they each fiduciary firms? That is key. You want to make sure that you're working with somebody who is required to put your best interests first, and then that feeling of whether or not you feel comfortable with them, that will tell you as to whether or not they actually are putting your best interests first. Then in addition to that, there are different strategies, as was mentioned in the question. So as far as buy and hold goes, or more proactive management and positioning for long term, here's what I'll say to that. Mark and I both believe in positioning for long term. Buy and hold can have a place in a portfolio, but the reality is this: it's not 1998 anymore. We can't buy and hold and hope for the best. It's not a George Foreman grill. We can't set it and forget it, right? We've got to make sure that we're keeping up with how things are changing in the world and how the investing world is changing. And so we want to look ahead as much as we can and plan for the future, have an outlay for the next 20 to 30 years of your retirement life, and make sure that you're working towards a goal, of course, with the potential that you might need to make adjustments over time. And hopefully that will help you narrow things down as to which one is going to be the right one for you. But I say those three things are really the main points to consider when you're interviewing new firms and kind of comparing one against the other. Here, I've got one to ask you, Mark. So it starts this way. It says, I've never rebalanced my portfolio. Because of this, I'm slowly acquiring more stocks through the years, but I'm making more money. Why does one rebalance other than if they can't stomach the risk? Is this the only reason people rebalance? To me, it doesn't seem as profitable as acquiring more stocks.
Well, that is a really good one to talk about right now, because rebalancing does matter. Now, I kind of understand that if somebody is just getting more and more stocks, I don't mind that necessarily if they're younger, you know, and they're on the young side of the investing age scale. But as we get older, and even for some younger people, rebalancing matters, and it serves two main reasons. So here's reason number one: risk management. Okay, so asset allocation is designed to accomplish two different competing goals: optimize the return and then minimize risk. So if you don't rebalance, what's going to happen is what was just mentioned in Casey's question. You're going to start to drift toward more and more stocks, and you're going to drift away from bonds. And that might not be the best thing depending on what the market and interest rates are doing. So rebalancing is critical, we believe, to keeping a portfolio on the track that it was designed to do. So what's the second reason rebalancing is important? Well, it's going to hopefully improve the returns. So by rebalancing, investors can help manage risk like we just talked about. They're going to align their portfolios with their investment goals, which should help to prevent overexposure to assets that have already had maybe a big run up, and maybe they're ready to retrace, you know, their rise a little bit. They're going to step back. The cost of that stock is going to start to retract, you might say. We're going to lose value. So rebalancing can help keep a portfolio on track. Now that takes us, Casey, to the next question. I'm the guy who never opens his investment account statements, because I'm scared to look, and because I don't really know what I'm looking at anyway, how do you help a guy like me?
You know, I'll say this: if you're scared to look, which we've had folks come in that are scared to
Absolutely.
look, that for us is an indicator that you're not invested the right way. Not at least not in a way that you're comfortable with. I mean, that's the reason that you're shying away from it, because you're scared of it. You don't understand it. You're nervous about what it's going to be. You saw the news and things weren't looking great. The market was red, and so you're concerned about what that's going to do to your statement. So that right there is an indicator of a problem. That's an indicator that you don't actually have a plan, and that you're not heading down a path for success, or at least that you don't know that you're heading down a plan for success. But the reality is that you're probably heading down a bad path. So what we do for somebody like that is help them create a plan, help them get invested properly, make sure that they're invested in a way that they're comfortable with. We look to balance assets. We look to explain things just enough that they feel comfortable and confident, but not so much that they're a matter expert. We don't want to put people to sleep when they're here in our office, right? But the reality is that having a plan will give you the confidence to open your statement and understand what's going on, and feel comfortable with it, because you know that it's part of the plan. It's not just something that's happening to you.
Tell you, going over the scenarios, a lot of people out there are like, hey, I'm kind of going through something like that. But it's not exactly what you're going through. You need to have a customized plan put together, because, all your puzzle pieces are going to be completely different from anybody else's. You got to make sure you have them all and they fit well together for your retirement, not just to retirement's door, but all the way through retirement. We give you an opportunity, kind of gut check time. See how you're doing. If you've not started planning, excellent opportunity. If you're in the middle of something, it's called a second opinion, folks. You can grab one right now, 866-668-3625. If you've saved $250,000 towards your retirement or more, these strategies are going to work best for you. Call the number now. Grab one of the 10 complimentary appointments, 866-668-3625. All right, a couple more scenarios. We'll hit them real quick. Here's one for you, Mark. I just remarried at age 61, and my spouse just turned 50. So from a retirement standpoint, we're years apart. I have an advisor, and my spouse does not. Should we both be using the same advisor, and should we find someone different than the one that I've been using?
I really commend you, because you're probably really going to outlive your spouse by quite a ways, especially being the female. So again, everyone's situation, you'll hear us talk about this every week on television, on radio. Your situation is really unique to you. Now, you having an advisor, I love that, because most portfolios are going to perform 3-4 percentage points maybe better if we have an advisor versus just doing it ourselves or with a robo-advisor. So it's something to keep in mind. Just because he doesn't have one doesn't really matter. Now, what I will say in that regard is if you want to start fresh, maybe have an advisor that nobody has any skin in the game with, well, then maybe getting a new advisor might be the right thing. But that doesn't necessarily mean that's the right decision. I think more important than that is that you find an advisor that keeps both of your interests first in your guys' life, not theirs, and really is helping you, especially if you're retirement planning, helps you with taxes, helps you with income sources, guaranteed, ways that are going to make your retirement income be solid. What about the medical part? See, so all of these things are part of a true retirement plan. So if you don't have an advisor that can help you in all those different areas, I might say, then you really should think about it, because it does matter. And there is a tremendous difference between an advisor that helps bring you up the mountain versus down the mountain. And that's, something we all need to really think about, which is, this last question, Case, why does a bond lose value due to government interest rate increases and advancing market conditions?
Real quick, the reality is this: if you can buy a bond today that pays out a guaranteed 6%, let's say, versus a bond that was purchased, that's for sale from 6 months ago, that only pays out 5%. Well, which one is worth more? The one that pays 6%, right? So what that means is bonds that have already been issued that are paying 5%, for example, are less valuable now that interest rates have gone up, and we can buy a bond today that pays 6%, right? So that's the correlation of the two, is that the previous one that pays a lower stated rate of return is not going to be as valuable as the new ones today at the higher interest rate.
Time to get some people into the office. We have appointments, gentlemen. What's going to happen for the next 10 callers?
Well, if you've been listening to the show, please pick up the phone. One of the things I want to stress is you don't have to worry about bringing a checkbook in or your credit card. Let's just have a conversation. We've talked about maybe you need some ideas for different tax strategies. We've talked about QCDs today and maybe Roth conversions. Is that right for you? Let's look at your individual situation and let our team of certified financial planners put together a written plan that you deserve to have. We can't stress that enough. A written plan can make all the difference in having a successful retirement. So pick up the phone, give us a call, and come on in and let's just have a conversation.
All right, we got the 10 appointments, and they are complimentary. 866-668-3625. If you've saved $250,000 towards your retirement, these strategies are going to work best for you. Call now. 866-668-3625. One more time, 866-668-3625. Another edition of Elevate Your Wealth, sponsored by Elevated Financial Management, is in the books. We'll see you on the radio next week.
Investment advisory services offered through Foundations Investment Advisors, LLC, an SEC-registered investment advisor. The content provided is intended for informational and educational purposes only. The views, statements, and opinions expressed herein are those of the individual speakers and not necessarily those of Foundations and its affiliates. The information contained herein does not constitute an offer to sell any securities or represent an express or implied opinion or endorsement of any specific opportunity, offering, or issuer. Any discussion of performance or returns is not indicative of future results. Each individual investor situation is different, and any ideas provided may not be appropriate for your particular circumstances. Foundations only transacts business in states where it is properly registered or excluded or exempted from registration requirements. Registration as an investment advisor is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. No legal or tax advice is provided. Always consult with a tax professional. All rights reserved.